Hello, welcome to our summer market update 2026. I'm here with another advisor on our team, John Gleason. Look forward to spending some time with you all today. But John, before we dive in, why don't you tell some of our clients what you've been up to this summer?
Yeah, it's been a great summer so far. Been playing a lot of tennis with my friends, which has been a blast. Just got back from the beach. It's great to be with family, and it's always good to be here, but it's also good to get away and then come back. So it's been a wonderful summer. What about you, Kevin?
Yeah, it's been a great summer. I got to go to Colorado with about 12 other families from Nashville from our church, which was great. And yeah, we're recording this in early July, so we just celebrated July 4th. And yeah, it's been a great summer with my family, and it seems like time's just going faster with a 9-month-old son and almost a 5-year-old daughter. But yeah, really thankful for the summer so far.
That's awesome. Well, before we dive in, some of the things on our radar that we want to talk about. Obviously we're talking about the market, but also thinking about some of the main headlines we've been seeing. So around Iran, and then around IPOs, specifically SpaceX, and then thinking about the two AI companies that have gotten a lot of news, so Anthropic and OpenAI. And then finally, we're going to touch on inflation. We also have a new Fed chair who was confirmed, Kevin Warsh, earlier this quarter. So we'll make sure we touch on all of that as we kind of move through our market update.
It's great.
Before we do that, the chart that you can see on the screen is related to the S&P 500 intra-year declines and returns. So if you look at this chart, you can see, in some years the bar is above the line, which would be positive, and other years it's below the line, which would be negative. So if you train your eye to the far right-hand side, you can see the year to date and the little arrow. That's where we are as of 2026. So the market is up 10% with an intra-year decline of 9%. So Kevin, I'd love to hear your thoughts around this chart.
Yeah, I think this chart's fascinating. This is one we show often, but as of June 30th, the S&P was up 10%, although we had a 9% decline at one point throughout the year. And if you look at the top left, it does explain that the average inter-year decline is 14.2%. So on the average year, the market actually moves 14% negatively, even though it ends the year potentially positive 35 of the last 46 years. So in some ways, it would be laughable, but it seems like this year is less volatile than normal. But that's actually what the data says, and it's just a good reminder to our clients that every year throughout quarter by quarter, we're going to see different things. But 35 of the last 46 years have been positive in the S&P 500, and as of right now, or as of June 30th, it was up 10%.
Thanks for sharing, Kevin. We're going to transition to talking about from the S&P to different sectors across the market. So on this next chart, you can see year-to-date performance by asset class. And so if you look on the far right-hand side, you can see that's where we are as of year-to-date. And so small cap is actually the driver of performance right now. Not many people would have expected that to be the winner. But if you train your eye to the far left-hand side and they kind of move across, you see that the different classes are actually changing as the year moves on. And that's because allocation is a huge driver of performance. So Kevin, would love to hear your thoughts around thinking about performance by asset class.
Yeah, I think just what this points to really, is just, no one really knows in a given year, in a given quarter, what's going to perform better, right? And so having good asset allocation is extremely important for our clients and something that, we really focus on. So yeah, it's just fascinating to see, even within the large cap space, large cap value to large cap growth, you have over a 12% difference this year, which is a massive difference. So I think just having the humility to have a good blend of asset allocation is something that we'll continue to rely on, knowing that we're not going to know what's going to perform the highest in a given year, but that we're going to have good diversification to make sure we have exposure to the right places. But yeah, it's fascinating just to see what's performed the best this year. Again, it seems like we'll look at this in the next chart, but year by year, it continues to rotate. So having good asset allocation has continued to reward investors over time.
Yeah, on this next chart, we're actually going to zoom out. So we just looked at year to date. This is going to be returns by asset class over the past several years. So if you look at this chart, I want you to call your attention to the very top left-hand corner where it says 2011 and then move across. So you can see this is returns by asset class since 2011 to be year to date. And if you notice, the colors at the top are always changing, and that's related to different sectors performing better in those years. So year to date in 2026, emerging markets is our kind of our number one performer. And that's kind of inside of the international sleeve that we were talking about previously in the last chart. And then right below that is the small cap. So you can see that, if you find the orange in different columns, that some years small cap has performed really well, and other years it has not been the leader. So Kevin, would love to kind of hear your thoughts when we look at kind of this overall allocation.
Yeah, this is fascinating, right? So I think being students of history is very important, right? And this chart is in some ways very humbling, right? Because you just never know what's going to perform best in a given year, and so it's nice to kind of track that over time. And I think what's really interesting is, we don't know what's going to perform the best in a given year, but having a good blend kind of gives us a smoother ride. It's obviously no guarantee that the portfolio is going to be positive, but we're essentially saying, having a blend of allocation, where that line is in the middle, you're going to have a smoother ride between all asset classes. Even the arrow that we've drawn the attention to on the far right, commodities have been extremely volatile this year. We're going to talk about that later in regards to inflation and what's happened in the Middle East. But again, it just brings us back to, we don't know what's going to be the best performing in a given year, and so having good asset allocation really gives our clients the highest probability of success of a good diversified portfolio and not having all of your exposure in one asset class.
Mm. We're going to transition next to looking at consumer sentiment and how that affects investing. So this next chart is an example of how that kind of moves throughout time related to S&P returns. So if you see the chart, the overall movement is related to consumer sentiment, so what the consumer is feeling, and then the percentages beneath that number is actually how the S&P performed for a subsequent 12 months. So, Kevin, we'd love to kind of hear your thoughts as we think about sentiment and market return.
Yeah, this I think is extremely important for investors to see, because again, it kind of brings us back to humility of, we never really know, right? And when we currently, sentiment is actually fairly low. I think that's because of a lot of what's happening in the headlines. That could be things from the Middle East to inflation to just a lot of change. And so I think, and it just brings us back to, like, we don't really know. Consumers are in this interesting spot, right? When the market's doing really well, people seem to think, well, it's all-time highs and maybe I should get out. And then when the market's really low, investors also think, well, it's only going to get worse, right? And I think what we have to continue to rely on is history. And so I think that's why this chart is so important, is to understand, hey, even when people think the market is going to come backwards or decline, however you'd like to say that, let's look at history. And again, if you go back all the way to that first chart, almost 3 out of 4 years in the market are positive. So we just need to continue to rely on history is our main thought, not to rely on consumer sentiment, because that can be misleading. And I think this chart does a great job of demonstrating that.
Thank you, Kevin, for speaking to that. So, speaking of history, you want to take a look at another chart that has historical returns on a rolling yearly basis. I think this does a great job of kind of explaining how we think about historical returns, kind of a long-term perspective we think of when we talk to our clients.
Yeah, I think, one of the things we really focus on is, clients' goals, right? What should their asset allocation be? Because that does drive their risk. And so, this chart is 75 years worth of data. But essentially, it's just showing the ranges of performance based on the different types of portfolios, right? So the green one essentially is 100% in equities. The blue is bonds, and obviously the gray bar is a blend of those, as you can see on the chart. If you're just listening to this and you can actually see the chart, just to explain what we're looking at. And then it goes through rolling times of history. So 1 year, 5 years, 10 years, and 20 years. And so obviously 1 year is kind of, the best case scenario and worst case scenario. So let's just focus on the equity portion. So the best 1 year performance is 52% to the positive, but also you have negative 37, right? That would be 2008 in this scenario. But the further you look out, right, the more promising things look. Obviously, that's no guarantee, but again, that's why we continue to rely on history, and we continue to uh, allocate clients' portfolios based on their goals and time frame, all back to this chart right here. This tells us a lot about what is worst case scenario, what does best case look like. Again, knowing that there's no guarantee of future results, but it's the best guide that we have to help a client pick what their risk potentially should be or could be, and how they would like to have their portfolio allocated to make sure it is set up around their goals. So I think it's just a fascinating and a really good reminder. And I would encourage investors to look at this chart, especially when they're not feeling optimistic about the market, because this really actually, the further you look out, I see nothing but optimism. Again, that's no guarantee, but I think history is a good guide and the best one that we have to go on.
Thank you for sharing, Kevin, your thoughts around that. So, we've kind of talked a lot about history. We're actually going to move forward and thinking about some of the headlines specifically around IPOs and SpaceX. And it's an exciting time. You've seen a lot of the news around specifically SpaceX, but then these AI companies going public as well. And so we just kind of want to touch on what that looks like within the S&P 500. Kind of looking at some history, but also looking at it now. So if you look at the most recent chart that we just put up, you notice that you see different colors in different years. So in 1985, we have the 10 largest companies in the S&P 500. Those are the greens. And if you start moving through time, you notice that some of them started falling out of the top 10, right? And if you look at '05, you see Microsoft joins the top 10 companies. It's the only company that has stayed till now in the top 10 S&P. So a lot of this has to do with innovation and thinking through what's driving the market. And so when we specifically think about SpaceX, for example, there's a valuation that's involved that leads it to eventually joining the S&P 500 and whether or not it'd be one of the top 10 companies. So Kevin, would love to kind of hear your thoughts around SpaceX and some of the AI companies and those IPOs that are highly anticipated.
Yeah, SpaceX was definitely all over the news, highly anticipated. It's been very fascinating just to even talk about SpaceX. I think a lot of clients had interest just because of how innovative the company is, also just the value of the company. Um, I think from its, we're recording this on July 7th, like I mentioned before, but from its highest point to where SpaceX sits today, it's actually down 32%, right?
Mm.
It's still up over time since it IPO'd at 135 to today it sits around 150. But it got all the way up to almost $220, right? So it's fascinating to see the volatility shift that SpaceX has had. I think what this chart is demonstrating in a little bit around our investment philosophy is, those the companies that IPO based on their market cap will continue to join this, and we don't know what's going to be around in 20 years. Will SpaceX be around? I have a good feeling it will be, of course, but it will continue to rotate through. And I think again, this points all the way back to just understanding your risk, having good um, diversification to make sure we're not putting all of our eggs in one basket. But these companies will continue to rotate, right? I don't think anybody ever predicted, that Walmart would not be in the top 10. That seemed like that company, obviously it's still a giant company and doing really well, but I think everyone thought that would be a staple forever. But technology has changed, and so we're starting to see more AI companies in the top 10, and it will continue to rotate, and we'll continue to make sure our investors are diversified and have exposure in the right spots.
Well, thank you for sharing your thoughts around IPO season and the fervor we're hearing in the news. We're going to transition next to talking about inflation. I know this is another hot topic that we've seen a lot recently. So in this chart, you can see, the headline is, energy is driving inflation. But if we look at this chart, this represents, overall movements in CPI. The large mountain in the middle is around the pandemic. And each of the different colors inside this represent different portions of the CPI that's driving inflation. So as you can see, the pandemic happened, inflation started coming down. We all kind of were feeling that personally. And then if you see these last little section on the far right, we see that inflation is starting to increase. Okay. The main driver of this has to do around the conflict with Iran and whether or not the strait is open or closed. So that's kind of choking the global oil supply, which is driving energy prices up. And then, as you all know, when you use oil to get places, businesses also use it as part of their supply chain. So overall, prices are kind of just slowly increasing. And the second major headline we're seeing along with this is the new confirmation of the Fed Chair Kevin Warsh, and his dual mandate at the Fed is to maintain appropriate inflation, but also make sure that unemployment is at the right percentage. So that's kind of when we think about this. We're thinking about what's driving inflation and kind of what the Federal Reserve is doing. Kevin, would love to hear if you have any thoughts as well you'd like to chime in on.
Yeah, this chart is definitely busy, right? There's a lot going on with inflation. I think it's been in the headlines for years. It will continue to be. In theory, I think what's important to think about is, okay, how does inflation and what's happening impact my portfolio, right? And so what I would say to investors is, the market is kind of always, in some ways, predicting what's going to happen with inflation in certain things, and over time, it trades based on profitability, right? And so some of the volatility that we saw earlier in this year was that there was a lot of predictions that interest rates would decline in 2026. And after some of the data started to come out, then the predictions changed to, well, maybe they're not going to decline. They're not going to lower interest rates, or maybe even they're going to raise interest rates. Obviously, that was disruptive to the markets. And so I think we'll continue to watch this because, again, no one really knows. Again, it's funny to see what people predicted at the beginning of the year to where we sit now. But, the Fed has a really hard job, right? They have to make sure that inflation does not get out of control. They're not trying to avoid inflation. They're just trying to make sure it's under control. And what this data would say is they almost had it under control, and then it started to creep back the other way. So in some ways, the market was doing too well, in their opinion, and so now they're trying to make sure that it's under control. Which again, we'll see where that leads them to. As you mentioned, we have a new Fed chair, so we don't have a lot of history on him, but some would point to, we'll see what he decides to do in order to keep inflation under control. Okay, and I want to transition to this next slide around interest rates. I think just to that point, we wanted to show this chart because I think what's really important is businesses are trying to understand what's going to happen with interest rates so they can plan based on borrowing money, scaling, what's their cost going to be, because ultimately that all impacts the bottom line. And so you can see if you just draw your eyes to the far right, the market expectations in 2026 was that interest rates were most likely going to decline, right? They were going to lower rates, which would give some relief to businesses that are borrowing money or allow companies to go borrow more money to expand. And that flipped when data came out. We'll just say in this last quarter, it all of a sudden looked like inflation was back on the rise. So maybe instead of lowering interest rates, they were going to have to increase interest rates. The last decision they ultimately decided to hold interest rates. We'll see what happens throughout the rest of the year. But again, they really do have a difficult job, John. They're trying to make sure that inflation doesn't get out of control, but um, but also that it's in this kind of 2% range. So we'll see what they continue to do. We'll watch it, and then, we're really at the end of the day relying on businesses that we own as equity owners or that we're loaning to in the fixed income world to navigate some of this. But we'll continue to watch it and make adjustments accordingly. But that is what's led to some of the volatility is people predicting interest rates to come down, and then now maybe they're going to hold or potentially rise or raise interest rates. Uh, Again, the jury's still out on what they're going to do, but we'll watch the new Fed chair, Kevin, and see what his decision ultimately is over the next several quarters of this year.
Makes sense, and thank you for sharing your thoughts. Another thing on our radar that we wanted to touch on is that the Trump accounts are now available. And we know several of y'all have reached out asking questions about that, but please feel free. If you have family members that qualify and you're curious, please let us know. We're happy to answer any questions and help get those accounts open for you.
Yeah, I would just add, my son is 9 months old, so his account is now live. I think, again, a lot of people are asking, okay, what's the best avenue to invest? And so happy to answer those questions. There's all types of different avenues, whether it's 529s, obviously now we have Trump accounts, you have UPMAs, you have minor Roths. There's all different kinds of avenues. So I think it really comes back to individual investors and their goals. But obviously, if you can get a free $1,000 from the federal government, just take advantage of it. So again, if you had someone, whether it's a child or a grandchild born in 2025, 2026, they're now available and with a free $1,000 from the federal government.
Well, thank you all for listening. It's been a pleasure to kind of share what's been on our mind. A few other things too I wanted to share. Our other advisor, Michael, has released his podcast called The Heart of Money. So wherever you find your podcast, please check it out. Money is a tool to reach your long-term goals. And we've actually left a link to it in this video as well. So please click that and check out what Michael's thinking about.
Yeah, I think it's just a great podcast. Again, it's a good reminder to kind of dream about money, and again, just to be reminded that money is a tool to be able to dream and reach your long-term goals. So, yeah, I just want to say again, thanks for listening to our clients. Thank you for your trust. We don't take it for granted. We come to work every day very hard for you all on your behalf. And if you're a potential client, we'd love to give you a second opinion on your current portfolio. Please subscribe below and feel free to reach out to us if you have any questions.
Yeah, we hope you have a great rest of the summer with friends and family. And thank you again for listening.